Hey investors, today I'm going to be talking to you about what is an ETF. Of course, if you're just a beginner, this is definitely the video for you. If you're more advanced and you already know what an ETF is, why did you click on the video? But anyways, today I want to be breaking down what an ETF is, but also one of my favorite ETFs right now in 2021 in February. So let's get down and let's check out what an ETF is and of course my favorite one. Okay, so my favorite ETF is ZWK. It's a BMO covered call US bank ETF. Now, what is an ETF? So basically an ETF is when you go onto your trading platform, whether you're with TD or somebody else, what you can type in is ZWK. And it's going to give you a couple of listings of different options for ZWK, but they may be ZWP or something else, but the one you're looking for is ZWK. It should be right on the top of the list after you type it in. From there, you're going to be able to see the stock price and if you want to buy or sell. But what is an ETF? So an ETF is very similar to a mutual fund, where it holds multiple different stocks. So this one is holding all American bank and American financial stocks, companies. And this is why this is one of my favorite ETFs, but I'll get to that in a bit. With an ETF, you're not just investing in a single stock, so you're not going to have what's called single stock risk. If one company doesn't do very well, but the rest do, then instead of having the single stock risk of your money disappearing and going down, it may even out or still make you more money because you're holding other banks. In this case, banks, but sometimes it'll be different companies. And there's always going to be bigger companies. For example, this one has JP Morgan, Goldman Sachs, Citigroup, massive companies. So with this ETF itself, we'll just hold the financial banks, financial companies in the United States. Now, this is a Canadian ETF that holds American banks, but you can find index ETFs, which are basically an ETF. An example of that would be SPY, which is going to be basically mirroring what happens on the S&P 500, the whole entire index, which allows you to still get a small dividend, generally around 1.5%, which will be dividends paid by those companies. And then, on top of that, if the whole market goes up, you make money. If the whole market goes down, you lose money. But generally speaking, historically, the market goes down, but it doesn't go down forever. We've seen it go down earlier this year, and then it recovered within a couple of months. That was a fantastic buying opportunity to buy that ETF, because now you can own a little small piece of all the companies on that market. Now, when you get another type of ETF, which is not an index ETF, there's ETFs out there that will hold very specific types of stocks. So, for example, there is HMMJ, which will hold just marijuana companies. There is ZWK, which is this one, which will just only hold US banks. But sometimes there is ETFs that will have a small twist. Instead of it just holding an individual type of stock, for example, marijuana stocks or bank stocks, it will have a small twist on how it can make you potentially more money. Sometimes it's more riskier and sometimes it's not. So it's really important for you to be able to read and understand what each ETF does if you're looking into one. So for example, this one, ZWK, it runs call options. It's called a covered call strategy, where it owns the stock but sells calls against those stocks. Why is this important? Well, for one, basically you're making a premium back, because when you sell options, if you don't know what options are, don't worry. Basically, they sell on premiums, and if the strike price is hit, which means, let's say that person who you sold that call option to says that let's say this this certain bank, let's say TD Bank, because we're in Canada. Let's say TD Bank We have a call. We're selling a call option to say, hey, you can buy 100 shares of TD at today's price, let's say $72, but you're betting on it within 2 months to go up to $80. Well, you're going to pay us a premium to be able to have the option to buy these at today's price. Now, if that price never gets reached, that option expires. We keep our shares, we keep you the premium you paid us, and you're now at a loss. And that's how this ETF is my favorite, because it pays right now over 8% on dividends every single year. It pays it out monthly. It's fantastic. It's great. If you're looking for a great way of making passive income, ZWK is the one. Now, other ETFs will not do call option strategies. It won't do option strategies. It's just like, for example, SPY will just hold the stock, and that's it. While HMMJ, which is the marijuana ETF I mentioned earlier, that one pays a dividend, and somehow it pays a dividend, but the stocks it holds doesn't really pay dividends, mostly don't pay dividends. How is this possible? Well, how they're running their strategy is they're taking the stocks that they have in the ETF and they're lending them out to short sellers who will take those shares and sell them in hopes to buy them back at a lower price. Well, then at that point, we still own the shares. He's only borrowing them to sell them. He's hoping to make a profit. I don't care what happens to him as long as we still own the shares, which we do, and he has to pay us interest. And with that interest that he's paying us, we get our dividend. So from there, this is basically what an ETF is. I really do hope that I explained this very well. If I have, hit that like button and subscribe, and I'll see you guys again next time.